Hello everybody, welcome to the First Home Buyer Seminar. I'd like to congratulate you for taking the step in learning information about a very important step that you're going to take as a first home buyer. Finding out a little bit of information around how to understand your affordability and a little bit about understanding lenders and what your options are in the marketplace. So just by means of introduction, who am I? My name's Beryl Colley. I own Brixton Mortgages, member of PAA and New Zealand Financial Services Group, and I call myself a specialist mortgage planner and property investor. Mortgage planner because I don't just source you a loan to buy your home, but I'll actually help you plan and understand how to structure that loan so that you're in a position right from your early days in your mortgage to be able to downpay it more effectively and reduce your interest costs. So I'll help you get into your first home and show you how to repay your mortgage faster. So why use a broker? Brokers are independent from the banks. We know all the banks' lending products, so we can ensure you that we match you up with the best bank for your needs. We'll offer you a level of support and education that you won't usually find at a bank. We'll often get you better rates than if you approach the banks directly. So one of the things that we do is we'll negotiate discounted interest rates for you, legal cashbacks to assist you on your way. Brokers get paid a commission from the bank, so we don't charge you a fee. So that means the level of advice and education and meetings that you get from us don't come with a fee from us. Okay, so into some information now. Homeowners need money for a deposit. Just going to talk to you a little bit about what's affected that for first home buyers. As of the 1st of October 2013, the Reserve Bank changed the loan to value ratio rules for banks lending. You'll often will often refer to loan to value ratio as LVR. Banks can only offer a certain amount of lending over 80%, so it's much harder to get approval for loans, but not impossible. So if you're listening to the media and the media are saying first home buyers over 80% can't get loans, that's not true at all. There are still a number of places where we can source lending over 80%, including some of the main banks. Understand though that any lending over 80% has what we call a low equity margin fee. It's called LEM, or some banks will call it LEP, low equity premium. Attached to it, and higher interest rates because we can't get the same discounted interest rates above 80%. But I'll talk to you some ways that you can do that will reduce your lending below 80%. So ways around these changes, or different ways that you can get your deposit. Welcome home loans. Welcome home loans will allow you to get into a property with a 10% deposit. There is a cap, depending on what part of the country you're in, as to what level of price property you can buy, but welcome home loans are certainly worth exploring. KiwiSaver contributions withdrawal can contribute to part of your deposit, but along with that, and a lot of people aren't aware of that, there's separate to the KiwiSaver a first home buyer deposit subsidy. There is an income cap on this, and we can send you some information to understand the first home buyer subsidy. But generally, it's $1,000 per year, so long as you meet your KiwiSaver requirements, which is a minimum of 3 years, up to 5 years. So you may get $3,000, $4,000, or $5,000 per borrower. So if we're talking about a couple and you both qualify, then that's $10,000 towards your deposit. It goes a long way. We can work with guarantors, so that might be leveraging off your parents' property and using their property as security, and that's a really good way to bring your loan to value ratio down, or to get into a property where you have good debt servicing but you haven't yet got any saved deposit. You still can get into the marketplace. Non-bank lenders. There are some non-bank lenders in the marketplace that offer higher loan to value ratios. So if your affordability works for the non-bank lender, we have access to those there as well. And then for some people, they have access to family giftings or family loans that can help top up your deposit so that we can meet the criteria for you. Just to cover a little bit about welcome home loans, as I mentioned, it allows you to purchase a home with only 10% deposit. There is slightly more documentation needed, so in many cases, if we think that you may be a welcome home loan customer, we'll ask for extra documentation right up front. There are higher interest rates, and there is an LMI fee, as with any loan that's over 80% loan to value ratio. The banks that currently do welcome home loans are Westpac, Kiwibank, the Cooperative Bank, Heartland, Credit Union, SBS, TSB, and there's a few other minor ones there. And at any time, other main lenders may be looking to offer welcome home loans in the future. Okay, just to cover off some information about your KiwiSaver withdrawal. This must be your first home, although in some extreme cases this can be extended to your second home. There is a second chance application. You must have been regularly contributing for 3 consecutive years. You can withdraw your employee contribution, your contribution, and any voluntary contributions. So I encourage you to connect with your KiwiSaver provider and find out what your options are, and this can help you in your planning process. The first home buyer's deposit subsidy is very separate to KiwiSaver, and as I said before, people often miss this or not realise that they have access to these funds. So again, it must be your first home. And same as KiwiSaver, you must meet the KiwiSaver criteria. Basically, you've been regularly contributing for 3 consecutive years. This application is done through Housing New Zealand and not your KiwiSaver provider. You can get $1,000 each year for each year you've been contributing. So if you've been there for 3 years, that's $3,000 up to a maximum of $5,000. So if you've got 2 of you buying a joint home together and you've been in KiwiSaver for 5 years, as many people now have in New Zealand, that's $10,000 potentially towards your deposit, which is massive. You can get a pre-approval for this, which lasts at least 6 months. So one of the things we encourage people to do is, if you are starting your process for finance, make sure that you get your first home buyer deposit subsidy pre-approved. So guarantors, I mentioned before about the use of guarantors. So you could ask your parents to guarantor all of some of the loan until you get your loan down to 80% loan to value ratio by yourself. This choice should always be talked through with your lawyer, and your parents need an independent lawyer to discuss it with. It can cause issues within the family further down the track. So I suggest that if you are going down the track of using a guarantor, you be very mindful of doing things when you're looking to buy, so that you can add value to your property, downpay some debt, and move away from being linked to mum and dad's property as soon as possible. The guarantor lending limits your parents' ability to borrow while they guarantee your loan, but there are several banks that limit their guarantee to the 20% deposit, so their guarantee can be limited. Non-bank lenders. Now, the Reserve Bank rule changes to the LVR don't apply to non-bank lenders. So that's where we have some non-bank lenders in the marketplace that can go up to 95%. They often require less paperwork and may be more lenient overlooking bad credit history or account misconduct. They do have higher interest rates and often shorter lending terms, but for some non-bank lenders, after you've been with them for a year and have shown good history, the interest rates can often be pulled back to closer to bank market rates. Family gifting or lending, as I said before, this method will need to be looked over by a lawyer. You need to show that you've saved a certain portion of your deposit or have it earned through sale of assets. So the banks do want to see that you've got the ability to maintain payments on your mortgage, and often showing that you've at least got some of your own savings can help with that. Again, this has the potential to cause family friction down the path, so make sure that everybody really understands what they are doing when they go into family gifting. So getting prepared to purchase, the first thing that I really encourage people to understand, which we can cover off at a face-to-face consult, is what is your price limit? Because what we don't want you to do is go out into the marketplace looking at prices that are well beyond your affordability, and then you start on a roller coaster journey right from the outset. So one of the things that we do in the consult is we get your gather your information and then go through your cash flow and affordability with you, so that you understand what your price limit is, and that helps you then identify what key suburbs you can buy in. Or for some people, it may help them identify, do I start with a 2-bedroom home, or do I go to a 3-bedroom home in a different suburb? So that will help you make some critical decisions from the outset. Setting the price limit, when we look at your cash flow and your affordability, it's important that you budget in some things like, apart from your loan repayments, city council rates, insurance for your house, but also for many people entering into home ownership, life insurance, mortgage repayment insurance, and income protection insurance might be something that you haven't considered until now, but they certainly need to be something that is covered off in this whole process. And then repairs and maintenance. No longer are you a tenant to a landlord where if your hot water cylinder fails and you can ring your landlord or property manager up, you need to be able to make sure that you've got a financial buffer to cover off those issues as they arise. Okay, one last thought. I often get asked by clients, should we purchase now or wait? And when we look at the cost of waiting, often the reason for waiting would be because you want to save more deposit. But when we look at most people's ability to save deposit, in the meantime, while you're still saving, you lose opportunity in the marketplace as property prices rise. And obviously, in some parts of the country, as the graph has shown, and we know with Auckland, prices can rise in different parts of the property cycle at a faster rate. So, if affordability works for you now, and you have sufficient deposit to get on to qualify for a loan, my advice often is purchase now and then start on your own plan of debt reduction so that you're creating your own equity. But we can again cover that off in your one-on-one consult. Just a little bit about property cycles, and I'm not going to predict it all at any way where we are at the moment, but you're always better off if you can buy in the lowest part of the property cycle. But because if you look where the green star is, and if you're buying up where the green star is, you're often buying and competing at auctions or tenders with an awful lot of other homeowners, first home buyers or homeowners upgrading. If you can buy when the market is a little bit slower, then you've got always a better chance for better quality negotiation is on your side. So here's the next step. One of the things that I think is really helpful for you before you go out looking for homes is to obtain a pre-approval. Once we've got a pre-approval, what that means is the bank have approved you, the borrowers, to X amount of lending subject to the property that you're going to offer them as security. That means that when you are out there looking at properties, you can focus all your energy and attention on doing your research on the suburb and the property that you're looking at, rather than then worried about getting your finance together in a hurry. Also means we can very quickly turn your pre-approval into an unconditional pre-approval if you're going for an auction or a tender, so that you can then consider with your lawyer what clauses you want in your contract. But it can also, as I mentioned before, help you establish your buying suburbs and criteria before meeting with real estate agents. And you can start becoming familiar with the market once you know what price range you're able to look at. So mortgages. Interesting word, mortgages. The term mortgage comes from very old Latin meaning, which was death pledge. So very long time ago, mortgages were obviously never meant to be paid off. Mortgages are a lending tool document that are registered against the title of your home. Currently, banks are offering 30-year mortgages. If we go back 5 or 6 years in time, 25-year mortgages were the common term that banks offer. But as we'll show you, most people are actually able to pay off their mortgage far quicker than the term of the mortgage that the bank set. So what is required to get one? We'll cover through with that. Pre-approvals, the benefit of those, and then how much can I borrow and which lender to use. Okay, I'm just going to talk a little bit about character and some of the tools and information that we provide the bank and that the bank can source to understand a little bit about your character. One of the things that the bank will do is they'll run a credit report for any loan applications on the applicants. If you haven't already seen a copy of your credit report, I encourage you to go to www.mycreditfile.co.nz and request a copy of your credit report, because if there is an issue on there that you're not aware of, it's far better for you to resolve that issue, get it paid and up to date, have an explanation letter go in with your mortgage application, than have the lender raise the issue and bring it to your attention. So on credit reports, the things that feed into credit reports are default payments and judgments, but also every time you do an inquiry with any financial institution for instance, a car, a HP, or a credit card, or a GE card, then that'll all store on your credit report. So if you've done a lot of short-term debt purchasing in a short period of time, all those things will total up, and your credit report is computer scored, so your computer score will drop down quite low. So I have seen credit reports with a very low computer score, nothing due to defaults, but because of a number of inquiries. So get a copy of your report and just make sure you're familiar with it. Payment histories with banks. The banks will look at 3 months of your current account statements, which we supply with your loan application, and they're looking for how you conduct your day-to-day finances with the bank. They want to see no unauthorised overdrafts, reversals or bounces. So just have a look at your own bank accounts and just make sure that those things aren't happening. They'll also look at number of outside debts and your appetite to short-term debts. So if you have the ability to downpay some short-term debts before you put your loan application in, then that will certainly help you. The other thing that they'll look at to assist you with assist in understanding about your character is how often do you move from one residence or one place of living to another, and how transient are you in your workplaces or jobs. So they want to see stable applicants as their preference. Okay, so I'm just going to cover off collateral. So collateral is your deposit, it's the quality of property and the property value. So firstly, they look at your deposit, how were they genuine savings, where is the deposit coming from, and how much is the deposit. Then they'll look at the quality of property. So if we are lending over 80% for you with a loan application, in all circumstances, you will need a registered valuation. So from that registered valuation, the bank can see a lot about the quality of property. If you are buying at a high loan-to-value ratio, it will be less likely that the bank will take on a loan where there's a lot of deferred maintenance that needs to be immediately attended to in order for the property to stay watertight, for instance. Because the bank knows that you're putting your financial reserves or your savings into the property. So consider the quality of the property. And saying that, buying a property where all you have to do is cosmetic improvements and you can add value is certainly something that I'll encourage you to do. The property value. Again, any lending over 80% loan-to-value ratio, you will have to supply a valuation, and we'll talk you through that process when the time's right. But if your valuation comes in lower than your sale and purchase agreement, the banks will lend against the lower of your valuation or sale and purchase agreement. So again, as a first home buyer, you don't want to be starting on the wrong foot. We want you buying at valuation or ideally below. And then capacity. The banks will look at your income, how much, the consistency of your income. They'll look at your repayments for your debts. As I mentioned before, they want to understand that you've got the affordability to not only meet your current financial liabilities, but your new mortgage is a liability that you're looking to take on. Children and cars are treated as liabilities on your statement of position, so the number of children and also the number of cars feeds into your application, and the banks all have different models as to how to model the cost of running a household, the cost of running a car. So just to cover off, what documents do we need from you to put in a loan application? And in many cases, when we're having our first consult, we're able to get most of these documents either from your email or your internet banking, so that the next day we're straight into putting in a loan application for you. But just to give you some thumbs up, we need a copy of your ID, driver's license or passport. Proof of your income, last 3 recent pay slips or a contract, or if you're self-employed, last 2 years worth of your financial income from your accountant. Recent personal bank statements, so that's 3 months for your current account where your pay goes into and you do your day-to-day living, and 3 months of your deposit savings history if you have any. When we do get these from internet banking, they need to be PDFs and not CSV files, so they need to be in the right format so that the bank can see the running balance. We need details on your debts, so we get you to fill out a statement of position that details all your liabilities. Some things that people commonly forget to put down are your student loans, because they go out before you get your pay. So student loan is treated as a liability and a debt. We need to have that there. So again, the completed application form, this is your statement of position. On the statement of position, we do get you to fill out a full expense sheet, because it's using that information we can help model for you how quickly you could pay your loan off, or what loan structure we would recommend for you. So I'm just going to talk through some loan options that are available and help you understand some loan terms, lending terms that are in the marketplace. A table loan, a reducing loan, is the same as what we call a principal and interest loan. That means if you take a loan over 30 years, the bank would structure the repayments so that by the time you get to year 30, you're down to zero. Hopefully the plan that we can show you would be better than that, but that is what a principal interest does. It reduces over time. Revolving line of credit is where you've got a small portion of your mortgage, where it's like you treat your revolving line of credit like an overdraft. Interest is calculated on a daily basis in your revolving line of credit. You can put money in, surplus savings in, and immediately your interest costs drop on your loan. So run with discipline and understanding, a revolving line of credit can be a very good tool. I always encourage people not to live out of a revolving line of credit. Interest-only loans are usually used for property investors, or if you are needing to take a break from your loan because we are starting the family, and for a period of time you need to settle back onto one wage. But interest-only loans are usually what we would use for property investors. We can split your loan into a number of different structures, and that's one of the things that I advise, is for never a loan to be fixed, all on one fixed term. So we can arrange your loan in a combination of fixed and floating loans. Fixed loans will give you certainty so that you know what your repayments are. Your repayments aren't going to change if the interest rates go up. They also won't change if the interest rates go down. So often having your loans fixed over various terms is a good way to manage this. So types of mortgage products. Welcome home loans, as we mentioned earlier, are done with the main bank, but they come with slightly different assessing criteria. And go through a different process. With a welcome home loan, you have to live in your home for a minimum of 6 months as well, and you can't buy an investment property with a welcome home loan. Standard loan is where you meet bank standard lending criteria. You have provable income and you meet their debt servicing standards. A low deposit loan, or a loan where we've got less than 20% deposit, may meet normal bank criteria, or we may use a non-bank. A construction loan, one of the exemptions that the Reserve Bank made with the low loan to value ratio was with new build, and I'm going to explain the difference between a construction and a turnkey. But with a new build loan, a new build property, we can get you lending up to 95% with only a 5% deposit, providing the new build that you're doing is a turnkey and not a construction. So with a construction loan, you'll pay the builder or the developer in installments as different stages happen to your house. With a turnkey loan, you'll pay your 5% deposit and you won't make any more payments until completion and you move in. So with a turnkey loan, we can get you 5%, providing you meet normal debt servicing criteria. Okay, how can I increase your borrowing ability? If debt servicing is tight for you or an issue, what we can advise you on increasing your borrowing ability, and we'll cover this off in your one-on-one consult, is to show you some ways to decrease debt and increase income. So we want to go through a plan of eliminating non-income producing high interest debt. So credit cards, hire purchases, and bank overdrafts. It'll be certainly in your favour if we're able to eliminate some of these before a loan application. So I've just got a quick exercise here we'll go through on the next slide, where we complete a budget. I'm sure none of you have got this amount of hire purchases, but we'll just do some of the examples. Complete a budget and put an extra $50 a week towards reducing your debts. So if we look at the fridge first, we are paying $25 a month on the fridge, and we're adding $50 a week, $25 plus $50. We're now paying the fridge off at $75. So the fridge is going to go very, very quick. Once the fridge is gone, we will focus our attentions on the warehouse card. So instead of paying $80, we're going to pay $80 plus the $25 that was on the fridge, plus the extra $50. So again, the warehouse charge card will again disappear very, very quickly. This method is called the snowball method. So by the time we get to the bank overdraft, we're paying $75 plus the $80 that was on the warehouse charge card, plus the $25 for the fridge, plus the extra $50. So again, once you start going through those, the remainder of your short-term debts start to tick off very, very fast. Consolidating your debts. Just to give you an idea, once you do embark onto a loan, one of the big mistakes that people do is when you're in a position when you've got equity and you're looking to consolidate short-term debts or buy a car, for instance, I'm just going to go through with you the cost of adding a $10,000 car to your mortgage. So if the $10,000 was added to your mortgage at an average interest rate of 7%, and we're only using a 25-year term here, your repayments a month would only be $71, but your interest paid over 25 years would be $11,218. So you add that to the cost of the car, you're paying $21,218 for a car that depreciates. If we did the car at 15% over 4 years, you would have to afford the payments at $278, but your interest that you pay over that time is only $3,355. Significant difference. Obviously, saving up cash is often the better way, but if you can't, really take some sound advice around how to structure these sort of loans, because many people make the mistake of consolidating debts and just add them to the length of their loan. So some ways to increase your income. We can be very creative about this. Take in boarders or flatmates, and that'll help with adding an extra income to your savings if you are saving for a home, or once you have got a home, taking in boarders can help with your ongoing household costs. Banks won't take in boarders income for debt servicing unless you've got a signed boarder agreement. Look, consider getting a second job, even if it's for a short term. If it's not casual, some lenders will take the second job for debt servicing, but again, it will help you save up your deposit faster, or get down some of those short-term debts. Always consider asking for the boss for a pay rise. They can't say yes if you don't ask. Okay, so tip: balance credit card transfers. You can get an interest rate often from the main banks as low as 1% per annum, and I have seen 0% as well for the first 12 months on balances transferred to various banks. This is depending on what the banks are offering at any one time. The key thing with balanced credit card transfers is the aim is to reduce your credit card as fast as possible. So what you want to do is maintain the same level of payments or more if possible. Don't add any new purchases onto your new credit card, because they will go on at a higher rate. So your new purchases don't attract the low interest rate. And then cut up and close your old credit card, because the aim is not to accumulate limits of credit cards, because that'll go against you in your home application. So I just want you to understand that buying a home is just the first part in your journey. Buying a home will allow you to get your feet on the property market and start growing an asset base for yourself, which you can leverage off sometime in the future, should you choose to start growing some wealth. Through your journey as a homeowner, there'll be things that'll happen: children, retirement planning, maybe a wedding if that hasn't already happened, business opportunities. So by starting to create some security with an asset is certainly a good thing to do. So why have a plan and why use an advisor? One of the things that we cover off in a consult is your goal saving and putting some time frames around that for you. Some people will often think that they're not in a position to buy a home, but when we have a consult and go through your financial ability, that may change. Encourage you to look at the big picture, and working with an advisor can help keep you on track and be objective, not subjective. Remember, you come to us because we're experts in what you're not an expert in, and often people get the wrong advice because you don't know what you don't know, and you don't know the questions to ask. So just remember that we're there to help guide you through that whole process. One thing to consider is a house is not your only goal in life, particularly not your only financial goal. So it's certainly good to get some really good financial habits from the start. So just some keys to your success. Select your goal. Know how to unlock your potential. Commit yourself to a plan, and whether that's a savings plan or a debt reduction plan or a house hunting plan, because until you do that, you can't chart your course. Expect problems. For some people, the home ownership journey can go really smooth, but for some others, it can be a little bit of a roller coaster, and it may be that you have to put offers in on several properties before you become the successful homeowner. But stand firm on your commitment, and once you know that, and make a commitment to start today, whether it's requesting a consult to start learning about your financial affordability. That is a good place to start. So just some budget tips. I think a really good service that everybody can do is have a budget, but the important things about budgets is to have a method of tracking your spending against your budget, and I have a really good tool to help you with that. But with your budget, keep it simple. Be honest with yourself, but above all, make sure that you have some fun money in your budget. And I sat down with some clients the other day, and there was nothing filled in for discretionary spending, so we made sure that we put in an allowance for holidays, gifts, birthdays, Christmas, spending money, because it all happens for most people. So we need to make sure that all those things are covered off in a budget to make sure that you've got a reasonable level of affordability. Know where your money goes. Many people are not aware how many holes are in their bucket. So I've got some tools, as I mentioned, to help you block these holes. So most people spend a lot of time looking for a home, little time thinking who should own the home, and are relieved when they get a loan approved, and spend little time exploring what loan structure is best. That's where we'll help you. Guide you through the loan structure and a really good sound understanding of that, and a review after you've moved into your home with any questions. So I said I would give you some examples about where your money really goes and how to down pay your mortgage. So where do you think most of your mortgage payment goes? Let's have a look. And if you see on this chart, and this is only a 25-year mortgage chart, it's not until years 10 onwards that you're actually starting to make much of a dent into your mortgage. And on average, people move house every 5 years and add time to their mortgage. How they do that is you'll discharge your mortgage and maybe move from bank A to bank B for whatever reason. One of the things I don't want you to do when you do that is start back at a mortgage at a full term, because otherwise you're going backwards in time financially. So every time there's a change in your personal circumstances, whether it's a change in job, an increase in job, or a drop in income, or you want to change your property, come back, we sit down, we have another catch up. Again, it doesn't cost you anything, but you can get some good perspective around what is the best thing to do. But here's an example, a scenario: a couple aged 25 and 26 with a mortgage of $260,000, so a realistic mortgage for their first home, and income each of $50,000. Their loan would have taken them until age 55 and 56 to be repaid if they pay it under the bank system. Under the new structure, which I will show you, their loan is expected to be cleared in 8 years' time with a potential interest saving of over $239,000. Now that's a massive amount of money to potentially stay in your pocket. The important thing to understand is your mortgage cost is not just interest, and banks will want you to be very focused on interest, and it is an important component. But the true cost of your mortgage is interest plus time. And if we're able to show you how to peel back the time, that's where you can make massive savings. So just really consider, how could savings like this benefit you? Or here's another example, a simple adjustment to the family spending, and in this case we had a $250,000 mortgage and put an extra $2,400 a year on the mortgage, and that saved $77,000 worth of interest and freeholded the property 5 years quicker. So the benefits of embarking on a mortgage structure that works in this way is it improves your cash flow at a time in life that you can start to invest it for your future, reduces interest costs, frees up equity faster if you did want to leverage off your home equity for property investing, and hit retirement with less debt. And one really important financial goal that most people should aim to attain to is being debt-free or mortgage-free in your retirement. So managing your mortgage. The type of mortgage you have and the way you handle your finances can make a big difference to your repayment time. We've looked at the 6 different types of mortgages and repayment strategies. Now this information that I'm going to show you has come off the Consumers Institute website, just to show you that those graphs really backs up and supports those graphs that I've shown you as examples. So here we've got, on the chart that I'm going to go through with you, we'll cover off 6 different types of loan structures. And again, there's a process that we go through when we look at how to structure your loan and give you advice on this. Remember, also our intent is to show you how to structure your loan to give you choices and flexibility, and not only repaying your mortgage faster, but leaving you in a position where if you hit a financial speed bump, you can pull back some of your surplus cash that you may have applied to your mortgage. On the chart that I'm going to show you, we've recalculated payments for a $350,000 mortgage, with repayment scenarios were based on 2-income family with each partner earning $60,000 a year before tax. And so here we see the most costly way of paying off the mortgage for this client is cost them on a principal and interest mortgage with minimum repayments $545,000 worth in interest. But there's 3 loan summaries or loan examples where the loan term is significantly less, under 15 years, and the interest costs are under $300,000. So there's a big opportunity for most homeowners to make some significant changes to the way they pay their mortgage, and a huge financial outcome for you. So our advice is different mortgage strategies will suit different households. We will look at all your options, not just the 6 we've considered, and see how they fit in with your lifestyle. Your own overall aim should be to pay the least amount of interest over the life of your mortgage, which means paying back the loan as fast as possible. So some tips, as I've mentioned before: always think carefully when adding depreciable consumables to your home loan. Work with a system that builds in some disciplines. Make sure there is money for you in your spending plan. So what we do, our focus, as I mentioned before, is to educate our clients so that you're successful in reducing your biggest debt faster, but also to support you in in your journey as a first-home buyer, which can be quite a daunting process. So who wants to own their own home? I imagine all of you at some point in that question process, because you've requested to join the webinar. Where to next? If we haven't covered all your questions, one of the things that we can do is offer you a free consult where we can assess your financial borrowing power, go over your affordability, and answer any questions that are personal, related to your own personal finances. So call us on 0800 55 7654. We work with clients nationwide, or send us an email to office@bricksandmortgages.co.nz. I look forward to helping you on your journey.